Good evening, all. It's 6 p.m. We're gonna hang out a few more minutes here to let some other people join. So the forum tonight is jump in with questions when you have them. You can put them in the chat. You can raise your hand. You can do whatever you want from that perspective. But please, if you've got them, jump in. That way we don't have to do all the talking. We can have somebody else jump in. So that'd be good. Um, let's get started. I think it might be we'll have some others coming in, but they can jump in.
Perfect.
So tonight we're going to go over from renting to ready. And I have this new program that allows me to kind of tab through things. So we can get into some of the slides that have a lot of context on it. That allows me just to let us focus on that. So um, we're going to ideally bring you along the journey from guessing, stressing, and endlessly scrolling into some confidence. And we're going to cut through the confusion with clarity, confidence, and a concrete plan to help you buy your first home in 2026, even if you don't feel ready yet. So, who are we? I'm Pete Jones. I'm a realtor here in Des Moines. I focus on helping first-time home buyers and sort of the move-up buyers, people whose homes they've outgrown, stepping into the next stage here in the Des Moines area. Specifically, Western suburbs, but Des Moines as well is really where I spend my time and my sweet spot. And then we've got Mr. Nolan. You can introduce yourself.
Yep. My name is Matt Nolan, and I work for Community Choice Credit Union here in Des Moines. Um, I focus in on people that want money. So my my focus is a lot of people. So anybody that wants to finance any home, lots or construction loans, but the credit union does offer a lot of lending also for other things. But my focus is just mortgages. So been doing it for a lot of years. I got a lot of gray hair and love to help anybody through the home buying process.
Wonderful. So yeah, we're not here to sell you. We're here to help you get a roadmap into getting your first home. You have the option. You certainly can work with us. You don't have to. We want to be here as resources and be helpful, and we're not here to pitch you from that perspective. So up front, just want to go through that. So quick check-in. I think I can unmute people. I'm going to unmute people. Um, maybe. Um, All right, we'll use the chat. If you could just chime in as to where you are right now. Who is just starting to think about that process of home ownership? You're still renting, but you haven't really taken any steps forward. And I have to think, Matt, I can't see the chat because I'm presenting. So if there's comments in there, if you wouldn't, can you see it?
Yep. Let me just pull that up. I think there's a way I can pull that up on the side here.
Okay. So just going to get a head count of who's in this stage. Who's out there actively looking into the browsing stage? You're probably haven't taken any active steps other than maybe getting on Zillow. Just want to get a sort of a head count from that perspective of who's in that stage. And then
Pete,
also, yeah,
I got one just starting to look. I got two actively looking,
okay,
um, and somebody's typing. So
okay. Actively planning.
yep.
So is 2026 your year? Have you come to that conclusion? Obviously, you still have questions. That's why we're here tonight. But you're actively planning. You think that this will be your year. Just curious who's sort of in that standpoint as well. And it does go, as it says here, and we're serious. Wherever you are, you're not behind. There's people in front of you, behind you, whatever it may be. But we want to get you to your comfort level, and that's what the intent of tonight is. Um, Common misconceptions in the world of first-time home buying. I want to be here to clear them up, and Matt and I both do. So a lot of people think that they need to have 20% down. I've created a lot of content around that myth, and I know others have as well. It's not a thing. You certainly can have 20% down on your mortgage if you have that kind of money sitting around, but you don't have to. There are many programs, we'll go into them here in this presentation tonight, that allow you to potentially put between 3 and 5% down, some even more aggressive than that, depending upon your credit picture. Um, you certainly can put 20% down if you have it, because it does change the payments you have going forward. And Matt will get into that in a little bit here. But you don't have to. So it is certainly a myth. You don't have to have 20%. Do you have to pay me if you work with me? If you are a buyer going into a transaction, buying a home, majority of the time the sellers pay me. So we can work together. I can help you find homes. I can help you figure out the front end of things, but I don't get paid by you. I get paid by the sellers of the home. In majority of the cases, there was a law put into place August a year and a half ago, um, where we have to have, if we're working with you, oh, software update, nice. If we're working with you, we have to have you sign what's called a buyer broker agreement, where I stipulate what the amount of money I'm going to be paid in order to work with you. But 98% of the time, since that agreement's been put in place, sellers are paying for the buyer commission, and it's advantageous for them to want to pay that. If for some agents, if they're not going to get paid 3%, they're not going to bring people to their houses. So it's advantageous if they want to sell their home to put that in there. So that's also a myth. Renting is always cheaper. I mean, there are obviously circumstances where that may be the case, but ultimately, when you factor in the equity that you build and the tax benefits you get, and a lot of the other things that go into home ownership, it's not the case. I don't want to say it's always not the case, but certainly majority of the time, depending upon the type of home and where you're renting and all those variables. But depending upon the circumstances, it's generally not the case. So these do people. There is a perception that these things are true. I have to pay the realtor 3%. I have to put 20% down. I have to do all these things, and it limits people's ability to look into it. It stops them, and so we want to make sure that we cover those right away. A couple more myths on this next slide. You don't need to be perfect. Matt, are you perfect? I'm not perfect.
Definitely
I
not. Definitely not.
Your credit does not need to be perfect. You don't have to have a perfect credit to get into a home, perfect being 800 or close to it. There are programs that can help homeowners or first-time homeowners, uh, people who are looking to become first-time home buyers into getting into homes in that 620 to 640 range or anything above. I don't know, Matt, do you want to speak on that more?
Yeah, I mean, like the getting approved for a loan. There's plenty of banks that will go into the upper 500s. I typically take the stance of I'd prefer to work with somebody to get their score up. One of the programs we'll talk about a little bit later on is the IFA program or the Iowa Finance Authority program, and they do have a minimum score of 640. And they don't play on that. They want 640. I had 639 the other day, that we need to go back to the hatchery for a little bit. We need to kind of get that score up a little bit. But the nice thing about credit scores are they don't happen overnight, but we can get them up depending on where you're at. So 640 is ideal, but there's definitely scenarios we can get that would be below that as well.
Another myth, not all loans require big down payments. We just talked about this previously, but this is a little more details of the type of loans. FHA loans can start at 3.5. VA and USDA loans can be, potentially zero, and those are all credit specific, right, Matt? As far as where they are, where your credit relies is what you can get from these. Is that right?
Most definitely, yes. The obviously for VA and USDA, USDA is a specific to a particular area. It refers to more of a rural setting. So it can't be you can't have a USDA loan in downtown Des Moines. It needs to be more in a smaller community surrounding Des Moines. And then VA loan would be the borrower would have to qualify for VA benefits, which are fantastic loans, and if you qualify, they're something I could definitely go into with you.
Got it. I think I lost my spotlight. There we go. All right. My Zoom link's in the way. I can't see this. You won't be house hunting forever. That is certainly true. I mean, there is a reality where you could continue to search forever if you don't want to find your home, if you're really picky and you're not going to find it. But in the grand scheme, majority of time, once you're credit approved, an 8 to 12 week window is really the window that we're most commonly speaking to with first time home buyers and home buyers in general, especially now because there's so much inventory out there, which we'll get into later. That is certainly a reality that makes sense. Prepared beats perfect every time. Yes, it does. I don't know why my spotlight's going off. That's frustrating. There we go. Prepared beats perfect every time. So that's the point of tonight and a couple of other programs that we'll talk about later. And my job is to make sure that you're prepared so that when you start that journey, say you go tour homes on day one and you find the home of your dreams and you want to write an offer, but you're not credit approved. Obviously, there's ways to make sure that we're in position that when that time comes, you're prepared and ready to go. And that's what the intent of today is, and other programs that we'll be talking about as well. So for that said, tonight's agenda, if I could speak, what we're going to go over tonight, a lot of things. It's going to be in depth in some spots, high level in others, but in majority of time, we're talking about down payment essentials. We're going to go a little deeper into that. Talk about your credit score. We've sort of high level talked about those quickly as far as the myths. We're talking about monthly payments, what that looks like, how that's structured, the home buying process, what happens from search to closing day, and then can you do it? Abso-freaking-lutely, you can do this, and that's certainly a thing we can get you there. So by the end of the night, we'll have everything covered. Ideally, we have all the questions answered. Again, if you have them, just go ahead and jump in the chat, and Matt can keep an eye on that for me if you would. Be
Yep.
fantastic as we go. So what is the real starting point? How buying actually starts? It's not Zillow. You'll probably hear a theme through this as we go. Not anti-Zillow, just, I have an opinion about Zillow. So pre-approval. Matt, if you could, I think we talked about this a little bit more deeply a little bit later on, but if you wouldn't mind, what is a pre-approval? If you could just talk through that with us.
Yeah, so there's sort of a terminology that different banks will use. There's a pre-approval and a pre-qualification. The pre-approval is when you submit your pay stubs, bank statements, social security number, that kind of stuff to the fill out an application with the bank. The bank pulls a credit report and kind of validates what you've got out there. The pre-approval is kind of what most lenders or what most sellers are looking for, because they want to make sure that the people are qualified that are walking through the house. But the pre-approval is going to basically give them faith that a banker has looked at your documentation and said, yes, it all looks good. So typically when I work with somebody, I'd ask them to send me your most recent 30 days worth of pay stubs, most recent 2 months worth of bank statements, last 2 years worth of W-2s. So just a little bit of documentation that kind of firms up everything. But that's kind of what the sellers are looking for, to have a little bit of faith that you are pre-qualified or pre-approved. When you do some of the stuff online where let's say you do a Rocket Mortgage or something like that online, it's more of a pre-qualification. And that's more, you put the data in there and they're going off of the data you put in there and taking that for gospel. The big thing that people usually put is whether your income is take home or your income is gross. Meaning, is it what you are in your actual paycheck, or is it what the starting line is before your benefits and all that kind of stuff are taken out? So all banks use your gross, which is the top line of your pay stub before all the items are taken out of it. So does that help?
Yeah, I consider it the fence post if we're looking at like a goal line or whatever the analogy is, fence post. So once you get pre-approved, how much of a home you can get. So you don't go looking at $500,000 homes if your pre-approval says, yeah, you're probably better off at a 250 to 300 or 350 range, just from a pre-approval perspective. And then also that comes down to the payment, which we'll get into later as well. But to me, it's the fence post. It tells you, and it's why I believe you should get pre-approved before you start house hunting, because you could be on Zillow looking at a house and think, I love this house, but your pre-approval doesn't speak to that number, if that makes sense. So I look at it as a fence post from that perspective. So just because you are pre-approved, let's use that number I used earlier, say 500,000 is your maximum approval. It doesn't mean it's the best choice for you from your budgeting perspective. So setting a smart budget up front makes sense. And we can work through that here in a bit as far as what that payment looks like and how you do that. And then, of course, we're going to go through into detail some of the upfront costs as well. Just make sure that you're on the same page. When you start the journey into home ownership, there are some out-of-pocket expenses that may or may not be um, well known. So we're going to go into those to make sure everyone's on the same page getting started. So as we mentioned before, clarity first, home second. That's how prepared buyers win. So talking about out-of-pocket costs. So some of these are hidden, some of these are known, some of these that you just once you get in the nuances of it all, you don't realize, oh gosh, I have to pay for that out of pocket. So it's important to know what they are up front. So as it says here, the down payment isn't the only thing. So when you make an offer on a home, there's a thing called earnest money that is necessary as part of that offer. So say the home's 200,000, your offer's 195. You have to, as the buyer, say, I'm also going to be giving a certain amount of money towards the earnest money, which is really a placeholder that's held during the transaction, and then that money is applied at closing. So usually it's 1 to 3% of purchase price. Now, for most first-time home buyers, and for most offers, $1,000 is a good amount of earnest money, and that's something that's held throughout the process. So it comes out of your account and it's gone until the house is closed, and then it's applied. That makes sense. Matt, did I do that justice?
Yeah, so like the biggest thing I say for earnest money is people think that that money is gone. It does get filtered down to the bottom dollar. So let's say you're planning on putting $10,000 down, and you put $1,000 in earnest money. That basically comes off the 10. So you then at the end of the day you'd only need $9,000 down. So
Yep.
even though you're out that money, it basically lets the seller know you're serious, and you've got some skin in the game.
Sometimes it's recommended if we're in a competitive offer situation, if it's the money's available to put more down from an earnest perspective, but that's a case by case basis. It's only if it's available. Um, Once the offer is accepted on the home, there's going to be a home inspection that's needed, and it's beneficial for you as the buyer to get that done. I use the analogy you wouldn't really go buy a car until you got it checked out. So this is the under the hood checkout of the home. Those usually range from $300 to $600, and those are done ideally within the first 7 to 10 business days after the offer is accepted. So it's an upfront cost that happens right away, and it's in addition to the 1,000 in this example we use earnest money out of pocket. So right away, if you're writing an offer on a home and it's accepted and you're starting down the process, there's an initial out of pocket expense right there of both of those expenses to determine what those are. Um, then down the road, and usually, Matt, that is if say it's a 45-day close window, usually the appraisal comes in towards, and I think we might, oh, I do see we have a chat. Oh, yeah, somebody joining, excuse us. The appraisal comes in towards later on in the process, correct? When does that usually come in?
Yeah, so typically, I want to make sure that we're through the home inspection time period. Usually the inspection time period's a 10-day window, so you've got 10 days to kind of, as you said, kind of check under the hood. Um, in that same time period, I would get the purchase agreement, and I would send some disclosures out, which is basically my legalese saying, here's the terms of the contract. But it just allows me to kind of move my process forward. Once those are signed, and I need to get those signed within 3 days of acceptance of the contract, then I would shortly after those 3 days, after those documents are signed, I would send out a request for the appraisal fee to be paid. So typically within the first week of writing the offer, with the exception of this, let's say the home inspection, you go do the home inspection, and there's some things that the home inspector says, you know what, I'm a little worried about the roof, or I'm a little bit worried about the windows, or whatever the case is. We want to make sure that we're past the concerning points, or at least it's the framework is agreed upon between buyers and sellers before we spend any additional money for the appraisal. Because obviously, if the deal's not moving forward, we don't want to have any additional funds laid out. Let's kind of just talk about that a little bit. Let's say the home inspection brought something up that windows are bad, roof is bad, something that's got a big ticket expense, and buyers and sellers can't come to terms on it. I think a lot of people want to know, and I'll let you answer this, Pete,
Yeah.
is what what happens to my earnest money at that point in time?
If you're a buyer and you've written an offer on a home and you've gone through the home inspection and say there's an item that the seller's not willing to negotiate on or agree to fix, you have the right to walk away from the home. In that case, you do get your earnest money back. So you would get the $1,000 back from that example. Should that happen, of course, we don't want that to happen because you've sort of had your heart set on this home. But at the end of the day, if it's not the right investment, it doesn't make sense to continue on with it. And so if that were to happen, we would, take a day, take a beat, and then start the journey again and start looking for the next home.
Yeah, and so basically, what I would like to do is I'd like to make sure that we're past the inspection time period before we spend any additional money
Yeah.
on the appraisal, and then once we're in agreement, and it doesn't happen too often, but occasionally it does, and goals to find the right house for you guys, and anyway, so then the appraisal fee at that point in time would be due, and it's all part of the upfront cost that we calculate for, but it is something that has to be paid for up front, and then it will show on the final document is that has already been paid. So that comes off the final dollar figure then as well.
And then if you're doing the inspection, there's other things you can add if it's at your discretion, whether or not you want to have a sewer scope done, whether or not you want to have somebody, the inspector, run a camera down into the sewer and make sure it's all good and not going to be an issue. If you want to get a radon test done, those are additional costs, and those are all detailed by the inspector. A lot of times I'm asked, do I have to figure out who to use from an inspection perspective? Absolutely not. I have people that I've worked with, and I can provide you a list of home inspectors that I've worked with and know personally, and you can choose from them as which one you want to work with, but you also can go with somebody you know as well. So it doesn't matter from that perspective. I just want to make sure that you have the right resources to make the right decision. Again with there we go. All right. So lending side, not slide. It says side. The lending side. How lenders look at you. I'm obviously going to defer to Mr. Nolan, Mr. Matt Nolan for this because this is your world. And yeah, I don't know if you want to dive in first with regard to the credit score.
Sure. Yeah. The I don't know if you have the slide. We had it earlier. You just kind of it was something that it broke down your credit score. So we kind of talked about your credit score. We want to have a 640 or better for a lot of the programs that are out there. But obviously, the better the score, the better the rate, but the better programs we can get you into. But that's one piece of what we look at, and your credit score is broken into 5 categories. And that was one of the slides we had earlier. But how you pay your bills is the largest piece of it. But the next largest piece of it is that basically it's your utilization. How much of your credit cards you're utilizing out of your available limit. So, for example, let's say you've got a Gap credit card, and I pick on Gap quite a bit, but a lot of the store cards have got limits of let's say $300 for a limit on a Gap card. Well, I'm sure I'm not talking to anybody in particular, but a pair of jeans can be a couple $100 as it is. So when you've got a credit card, let's say it's a Gap card, and you've got $300 as a limit, and your balance is $300. What that looks like to the credit scoring model is that you're 100% utilized, or you are maxed out on that credit card. And you could say, well, Matt, it's only $300. I mean, I make $40 million. I hope that's what the case is, but I don't know if that's anyway. But so the one thing that the scoring model doesn't take in consideration is what your income is. So it doesn't matter the fact that it's only $300, and you could pay it off in a day or week or whatever. You could really drive your score down by your utilization percentage. So those are kind of some of the things we look at when we look at how can we boost your score up. We mentioned earlier that I'd prefer to work with somebody to get their score from, let's say, 580 to 640. Those are some of the things I would look at real quick to kind of get a quick bump in score. But that's definitely one of the key components, and that sets a lot of things. Whether we can agree or disagree with how the lending has evolved. It used to be kind of more of a make sense, but we've kind of all gotten, whether it's lazy or what, but the credit scoring model is basically what your rates are depicted upon, and it's just the world we live in. So score is a big piece of it. And then we got the stability income is another piece, and stability income comes into play. And if you are a let's say a W-2 employee, which would be just you work for an employer and they send you a W-2 at the end of the year. Typically you're either hourly employee or you're salaried, but those would both be W-2 employees, and those are probably the most stable for an underwriting standpoint. Versus if you were what they call as a 1099 employee, let's say that you own your own hair salon, or you own a company that you don't work for an individual. You basically work for yourself. You're self-employed. Um, Underwriters I want to see a 2-year history of stability of income for anybody that's self-employed. So if you're W-2, I need a 2-year history, but it doesn't have to be at the same job. If you are a self-employed individual, we need 2 years at that job, or at least that function, which then kind of all flows into your debt to income ratio. And your debt to income ratio is simple as this: is it just add up all your monthly payments divided by the income you have, the gross income you have. And most programs need to have that debt to income ratio at 50% or less. So let's say that you want a mortgage payment at $2,000 a month, and you've got a car note, credit cards, and student loans totaling another $500. So your total debt payments would be $1,500 mortgage payment, $500 in other payments. Your total debt payments would be $2,000. So, yep, it looks like it says ideally 43%, but we can go all the way up to 50% of your gross monthly income. So I kind of jumbled that up a little bit, but hopefully that kind of makes sense. Anybody have questions about how they calculate the debt to income ratio or income? Typically, I like to make sure that I see documentation on the income, and that's part of the pre-approval process. And I can usually, I've probably found most different positions out there. I know what types of roles they are. I'd say the truck drivers are probably one of the most inconsistent, because sometimes they can get paid by the mile, the hour, the job. There's a lot of different scenarios out there, but so that's something that I could definitely work with you on, as far as if you've got different income streams.
Matt,
So if you're the question is, so if you're self-employed, you can't use bank statements as well. Great question. There are programs out there. It's called bank statement loans, and they do look at your cash flow coming in and out of your bank accounts. Typically, those types of programs are you're not going to get the best rates out there, but there are programs. They're bank statement loans, so they're going to look at a 2-year history of your credits and debits coming in and out of your bank account, and calculate income based off of that. Typically, if you're self-employed, we'd want to see your tax returns. If you look at your tax returns and I can show income off of those, we're going to get you a better interest rate and a better program using your tax returns. But great question is there are programs out there that will allow us to use your bank statements, but they get a little bit more complex, and you're typically not getting the top tier rates in those scenarios.
so as mentioned here in this last little bit here, strategy matters. Working with a lender that you trust matters, and finding the right program matters. There are options and different things that change throughout the process, so it just makes sense to know who you're working with and have trust in that person. I think I just stopped to share. Excuse me. I didn't mean to do that. You can see you can see the slides again.
Yep, we're good.
Cool. All right. All right. So improving your credit score. Say you're in a situation where 640 is not a thing and you're not there, but you're looking to get into a home. I think Matt might have gone into some of this already in a little bit, but maybe a little bit more detail. Matt, if you want to dive into this one.
Yeah, so like I would say the easiest thing to do with credit is pay your bills on time, right? But let's face it, life happens and things happen, and we just need to meet people where they're at. So the biggest problem I see with people, if let's say there's a situation that occurs, whether it's medical, whether it's divorce, whether it's whatever the case is, and we get into a financial trouble, let's say it's even bankruptcy or something to that effect. Credit scores are kind of funny where you could fix them, but it takes a little bit to do. But doing nothing on your credit is not helpful. So sticking your head in the sand and hopefully it gets better. It's not a viable solution for it. So making payments on time is huge. But let's say that something happens, and let's say everything gets if I have to file bankruptcy, rebuilding credit is something you could definitely do, and on-time payments is a huge thing. But you basically just need to get something else out there that shows some good credit after something bad that happens. So payment history is a big piece of it, but sometimes we need quicker fixes, like I talked about earlier. This is now talking about reduced debt and utilization. The store cards are what I talk about most on utilization. And again, I pick on Gap, but it doesn't have to be Gap. It could be Gap, Shields. Most of those cards are low limit cards. So they're trying to get you to buy more stuff at their stores. So they'll give them out fairly freely, but they've got very low limits because they want to limit their exposure. So a lot of them will have a $300 credit limit to it. Well, again, if you put $300 out on the card, the bank says, hey, you know what, you can spend $300 in the credit card. You think, okay, well, I'm spending up to my limit, but the credit report will really crush your score, even though you're still within the term. So utilization, you want to be at 30% or less. So that you can kind of see on that slide there. So if you have a $300 limit on a credit card, you want to be at $100 or less, which sounds ridiculous, but if you go spend $500 on a weekend or something like that, all you got to do is when you get home, just pay the balance down. But you want to keep that balance to 30% or less of your limit. Some different credit builder programs that are out there. One of the big key things I typically will try is if we've got a low credit score and we're trying to maximize a credit to build somebody's credit up, there's something called an unauthorized user card. So if you've got a family member that's got a credit card that we could add you to as an authorized user, that will definitely give it a quick bump up in score. There's some other they're not prepaid cards, they're secure credit cards. So you can get a secure credit card, and a secure credit card is where you would bring in, let's say, $300 or $500 into the bank. Then you would get a credit card with that limit to it. So the bank is kind of secure in the fact that you could spend up to your limit, that whatever you've got in that bank account. But it's a way that the bank is protected, and it allows you to build your score up. Time to improve your credit. Typically, I can look at somebody's credit report and say, okay, this is what we need to do. We come up with a game plan. And we need to pay this off. We need to do this. And 6 to 12 months is a good time frame. Sometimes I can get it done in 30 days. But sometimes it could take up to a year too. So, that's probably the worst thing I've got in my position is I want to help somebody, and they come to me and they say, I've got this house on 123 Main Street that I really want, and credit doesn't work that fast. I mean, we need a little bit of time to kind of work with it. Addressing issues on credit reports. So there's different companies out there that will help you dispute items, things you can do on your own. But there's companies out there that have systems set up that they'll dispute items for you and kind of help build your credit. And I definitely have contacts that I could refer you to on that.
And that's all of this is why I recommend if you're starting the process, you start the process with getting approved first, because the last thing you want to do, I hesitate to say it's the last thing you want to do. Oftentimes what happens is you start looking at homes, you start falling in love with homes, and then you look at your credit and say, oh, I have maybe 6 to 12 months before I can get it done. So you don't want to get your skis too far ahead of yourself from that perspective. And so that's why I recommend that. I think
So
maybe,
Pete, there's one question
yeah.
here. What's the best credit score to have? And can you have items deleted or removed off your credit? Um, the best credit, I mean, so the FICO score model goes up to 850. I've had a few 850s in my tenure, but really 640 is kind of like as I said before, um, most of the down payment assistance and different programs, bless you,
Right. Excuse me.
um, will allow, they want to be at 640 or higher for a score. So 640 is kind of where I'd like to start. But doesn't mean that if we're below that, that we can't work with you to get you up. And can we have things deleted or removed from your bureau? Yes, you can. There's a lot of companies out there, and it's kind of a dirty business. So I do have a company that I work with. It's called UQual, and they do a pretty good job. They do. There's a fee for their service.
Excuse me.
Bless you.
Thank you.
But there are a lot of companies out there. I'm trying to think. Lexington Law is probably one of the worst predatory places out there that I've had a lot of bad feedback from customers. But there are different companies out there that have online disputes. Technically, the bureaus are not supposed to remove things if they're legitimate. So, but it happens all the time. There's companies, again, this UQual, they'll dispute things over and over and over again. And if the credit card company or whoever's got the derogatory item on there doesn't respond within a 45-day period of time, then it has to be removed off the bureau. So, yes, items can be deleted off there. It doesn't happen easily. There's ways you can do it. It's called pay for deletion. So it kind of gets into a whole different segment of that. But just know that the credit repair business is probably a little bit on the dirtier side, I guess, because there's a lot of different people that get different opinions or it's not easy to do, but they're definitely quick to take your money to help you fix your credit. So definitely things I can talk to you about, but there are certain ways we can do it too.
All right. Matt, apologize. It's your slide again as far as
All right.
content that makes sense to talk through. You touched on a little bit of this already, but if you wouldn't mind, let's dive into it again here, if you will.
Yeah. So like we talked about, if you're self-employed, 2 years worth of tax returns is what we look at. Again, we talked about the bank statement programs. There are some out there that's 12 months worth of bank statements we need to look at. And there's probably other companies that probably do a better job than what I'm set up to. But I definitely have people I refer people to. But for a W-2 type of employee, 30 days worth of pay stubs, and the last 2 years W-2s. Might need tax returns depending on if you get any commission income or tip income, and it's going to be an interesting scenario right now where there's no tax on tips. So haven't seen one of those tax returns, so I'm not sure how those look. But I think you still have to declare it because I think it's only up to like 25,000. Asset statements need 2 months worth of bank statements, and we'll probably talk about this in another slide or two here, but there are some programs through the Iowa Finance Authority that we can do where we don't need assets. Identification history, just basically a copy of a photo ID, Um, we've got security card on there, a social security card. A lot of times they're not needed. It's only if the bureau has a question on it. It doesn't have a validation that it can't do in the behind the scenes. So typically, it's just a driver's license or a government issue ID. And then employment details as far as we would send a verification of employment to ensure that the documentation we have matches what the employer has.
Great. Yeah, and I know I'm asked this a lot. What are the things we need to get the process started, and how do we make it the most efficient? Well, going through this list and having this available, and I'll as part of attending tonight, I'll be sending you a checklist which has a lot of this information on as well. But having it ready ahead of time saves you time having to go back and find it, and it's just makes the process more simple from that perspective. So help that actually exists. Matt, this is where we start talking about some of the programs. And I think after this, you maybe can take a rest your vocal cords and
All good. I like talking. But so the program I use the most, and I mentioned in the last slide about assets. I partner with the Iowa Finance Authority, and they've got some great first-time buyer programs. And I've got my spiel that I do with the IFA program, and the one I typically use. They've got several different programs. I'm partial to the 5% down payment assistance program, but again, this does have the 640 minimum credit score to it. But what they'll do is they'll give you 5% of the purchase price that you could use towards down payment and closing cost. So my scenario that I typically throw out there is, let's say you're buying a $200,000 house. Again, just easy math for me. 5% down payment assistance would be $10,000. So IFA will give you $10,000 to use towards down payment and closing cost. The catch is it's a free loan, but it's not free money. So let's say you buy it for $200,000, we use that $10,000, so you're financing $190,000. So let's say their catch is that you need to pay that back when you go to sell or refinance the property. So let's say you keep the house for 5 years. At the end of that 5 years, they want their 10 grand back. But there's no interest, there's no payments, there's no nothing on that $10,000. So again, the scenario is, let's say you buy it for 200, your loan amount's 190, you pay on it for 5 years. Let's say you pay that balance down from 190,000 down to, let's say, 175. So at the end of 5 years, you have a balance of 175,000, but hopefully the house appreciates a little bit in value. So let's say it's worth 225 in 5 years from now. So when you go to sell that house, you're selling it for 225, you owe 175. So that $10,000 has to be paid back out of that spread of that $50,000. The rest of it you can use when you find if you want to buy something else. So it's a great way. It's a great way to jump into the housing market, and kind of takes that hurdle of the down payment out of it. Most people can afford a monthly payment because they're paying rent or something now. It's just they can't get that down payment. So that's a great program that I use all the time to help people. And when Pete would put an offer together, as long as we're in concert on what we're looking to do, when he put an offer together for you, let's say you're buying a $200,000 house, he might ask the seller to pay $3,000 or $3,500 and seller pay closing cost. So in essence, you could actually come to closing. We'd use the down payment assistance from IFA. The seller would pay all the closing cost. You could actually come in and not have to put anything down to buy a house. So some of my best days are when we go to closing table and I'm giving somebody a check for $500 and they're getting keys to their brand new house, or they're new to them house, I guess, in that case. So,
Iowa Finance Authority, what are the fence posts on that again? What's the threshold? 640 credit score and income?
640 credit score. And the other big thing is that they do have an income cap. So you have to be under $114,000 for household income. So if you're married and you both make $60,000 a year, that's 120. So you're going to be over that income cap. There's some programs that exist above that 114,000. but the rates are not as good on the other program. So I typically try to do the first time home buyer program, which is that 114 for cap of the income.
There are, as said here, other programs outside of the AFA program. There's two organizations in town. Neighborhood Finance Corporation is one that if the house is within a certain area of town, they have advantages and amount of money that they'll give towards down payment as well in different programs. There's an organization called DSM Invest, which is similar. They work in conjunction often with Neighborhood Finance Corporation. They also have programs. Theirs is more geared towards revitalization. So you say you buy an older home and you're in a specific area of town, they'll give you money to make improvements on the home. So new siding, new roof, whatever it may be. So there's different programs from that perspective that are above and beyond or outside of this Iowa Finance Authority program. And then there's other just programs out there as well, outside of those as well.
Pete, we just had a question. Does West Des Moines have a program? And yes, they do. Actually, I just closed one the other day. It's really targeted, and it does. It's for the kind of the Valley Junction area. I want to say it was a $15,000, and it's there's some fine details with it. And I could probably get some data for you if you're interested in it. But it is very targeted for that Valley Junction area, and they're trying to revitalize that to get people to own or occupy those versus have those as rentals. So a lot of the money that they've got available to you, they want you to invest back into the property, and whether it's improvements in windows and siding and in beautification of the property. But that's the program. And I literally just did one. It was the first one I've done. And I do have some contacts if anybody's interested too. That's a little bit more self-directed, where they want to be working with you individually. So you have to upload documents directly to City of West Des Moines, and they approve you based off of some different criteria.
Yeah, but all this is why I say it makes more sense to start the journey with a lender and a pre-approval, because there's several different, a multitude of different options that are available that the average person may not know, and a lender certainly will. So this makes sense from that perspective. So let's talk budgeting beyond the mortgage payment. We had in this situation, Matt, and I think this slide will speak to it. This first part, I guess. We had a situation where, and I'm just going to use rough numbers like we're using previously. The individual was approved for $200,000, but when you backed in all the payments that are above and beyond the mortgage payment, they really should only get, from a monthly payment perspective, a house that's roughly $150,000. And that was due to a multitude of different things that I'm hopeful that Matt will go into.
Yes. So in the situation Pete was talking about is I think we had approved somebody for a single family house, which we accounted for the taxes and insurance. And just talking in generalities, that if you look at Des Moines proper, the taxes on properties in Des Moines proper, they seem like they're a little bit higher than what they are in some of the suburbs. So the situation we had is they were looking at a single family property, and I think they could buy a single family property up to roughly about $200,000. And then they had looked at a property that was a part of a townhome and or a condo complex, where then you had to take into consideration the HOA dues, which then drastically dropped the pre-qualification amount, because on a single family home, you don't have those HOA dues that are out there. So when we look at budgeting, we want to make sure that whenever I work numbers for somebody, I'm going to tell them what the principal and interest payment is, which is great. And typically, if you do some online calculators, in some instances, they only tell you the principal and interest payment. But in all payments, you need to assume that there's some type of taxes, because there will be taxes on it, unless you're in a tax abatement. That's a completely separate conversation. But we had to account for taxes as well as homeowners insurance. And I see that you've got on here that we're between 80 and $150 a month for homeowners insurance. Um, I will say we're probably all of that 150 now. We've had a lot of insurance situations that have come through Iowa where we had the derecho, we've had hail different events, we've had tornadoes, et cetera, et cetera. So the homeowners insurance I usually calculate is about $150 a month, and then for tax insurance. But when we kind of talk about payments, we're being a little disingenuous if we don't give you the full picture, right? So sometimes when you do the mortgage calculations online, it will only tell you what your principal and interest payment is, which tells a piece of the story, but then tax and insurance tells the rest of the story. Or if you found a townhome or a condo, we need to make sure we're accounting for the association dues as well.
And what happens a lot of times with clients that I'm working with who are also working with Matt is, and Matt has a life, so he doesn't work 24/7, but a lot of times it's, hey, I like this house. Matt, could you run the numbers for me to help me figure out what the payment would be? That's a common situation, and he puts it into his calculator and he's able to spit it back out. Because when you figure in the mortgage payment of X, then you have taxes on top of it, which the numbers are here. You have your homeowner's insurance on top of that. If you didn't put 20% down on the mortgage, oftentimes there's PMI insurance as well. And if you are looking at doing a townhome or a condo, oftentimes there's $150 to $300 HOA expense on there as well. So figuring out how that looks on your budget to make sure that you can pay all the other things that you have to pay and not be house poor. And what's the analogy? House poor and anyway, I forget what the saying goes, but you'll make sure that you're getting into a good situation financially. And
Yeah,
and then you got to think about, all right, I get a house and I got to pay for all the utilities as well. And so budgeting for that. And then if you're able to, it's recommended to put aside about 1% of the payment of if it's $200,000 house, 1% of that towards annual maintenance. So you can continue to keep it up so that if in 5 years, when Matt said earlier, you go to sell it, you're able to make more money down the road than having to dump money in at the end or just being proactive ahead of time. So owning is more than just a mortgage payment. Plan for the full picture so you're not stretched thin is the intent for this slide. So let's talk local market and inventory. We had the latter part of last year, so November, December, we had more homes in the market than we've had in 12 years here in Des Moines, in excess of 4,500 homes on the market. Right now, I looked this afternoon, it's January, what, 13th? We have 3,919 homes in the market right now, which it's not 45, it's not records, but it's a heck of a lot of inventory. Of that 3,919 homes in the market, 1,606 are under 300,000. So that's 41% of the whole market is homes that are more first-time home owner friendly because of the price point. So under 300,000. Only 16% of those are new construction. So there are a lot of resale homes on the market right now in Des Moines, and that's not uncommon. Generally, new construction homes are above that $300,000 price point, so that's not uncommon. There are another 1,113 homes that are between that $300,000 and $400,000 threshold right now on the market. Of that price point, 55% of those homes in the market are new construction. So you can see new construction starting in that 350 range, generally and above. So most often, most of the opportunity right now from an inventory perspective is the resale homes. And just to give you perspective, activity's been strangely active right now, and I think rates are lower than usual, inventory's higher than usual. In the last 7 days, 214 homes have sold in the metro. 307 have gone pending, meaning they've had a contract accepted and they've gone into pending status, which is where you do the inspections and all the things. Um, there have been 352 new listings in the last 7 days as well, which those are good numbers from a inventory perspective. So the indications are, and the activity is, and I know this weekend I had an open house where we had 7 groups come through the house, and that's I've been in that home previous open houses, and normally we'd get 1 or 2. So a lot of activity, a lot of buyers out, and I think that's a response to the rates being lower. The weather was relatively nice this weekend, and that helps. But the perspective of what 220 to $300,000 buys today, generally speaking, depending upon the area of town, a 220 to $300,000 home is a good solid 3-bedroom home. There's obviously good schools, good amenities, and from this perspective, national news. Here's an example. National news have been saying rates have been above 6% until just this past week, whereas here locally, I know Matt's Credit Union and others here locally have been offering rates well below 6% for 2 to 3 months, depending upon credit picture. So relying on the national news oftentimes is causing hesitation when in reality, the local news and then the local reality rather is oftentimes different. So preparation is very important from that perspective. Any questions on inventory? Just to summarize, there's a lot of it, and a lot of it's under 300,000, which is usually ideal for a first-time home buyer from a price perspective. But there's even, up in excess of 300 to 400,000, and even above that as well. But I just looked at those numbers, so no questions on that. Let's talk about, maybe there is one. Is there a question there, Matt? I can see the icon, but I can't see the question.
Yeah. Um, are there a lot of townhomes and duplexes for sale?
There are. There are. The issue that we're running into, I don't want to say issue. There are certainly a lot of townhomes and condos available. I didn't look at those numbers specifically, so I don't know the exact numbers, but I know the inventory's there. When you're getting into those, there's always going to be a homeowners association fee included on those, and we talked about that briefly in the payments earlier, and that can vary from 150 to much larger depending upon the perspective. So one thing we do when we're considering a townhome or a condo is if it's a property that you're interested in writing an offer on, before we do that, I'll reach out to the listing agent and I'll get the meeting minutes, the financial statements, and the overall documentation from the HOA, and I'll do a deep dive into the analytics, the data, to make sure that HOA is spending the money that you would be investing in them from the monthly payment in a wise way that's beneficial to you. There are lending institutions that have concerns about lending to those organizations or some condos and townhomes, depending upon how those HOAs are structured. And ultimately, it comes down to, are they putting enough money away in cash reserves to benefit you and make sure that they're essentially spending your money? Is that correct in what I'm saying there, Matt?
Yeah, it definitely is, and I think the condos is townhomes and duplexes as well. So, what I find with duplexes, one quick note on that is, I love it for an investment standpoint. Living on one side of it, you can still call it your primary residence, and then rent out the other side of it to help subsidize your mortgage payment. So I love the concept of it. I will tell you the IFA program, or the Iowa Finance Authority program. Typically, it's set that you cannot have a multifamily, so you can't have a duplex. It's single family only for the IFA program. But if you are able to put 3.5% down, duplex is a great way to do it. I think it's I've told my kids this a number of different times when they're ready to purchase, if they're able to buy a duplex and live in half of it, have the other renter subsidize it a little bit. It does help quite a bit. The only drawback on duplexes I will tell you is there's a lot of investors out there looking for duplexes, and a lot of investors would pay cash for those. So they're probably not going to go as high as what most people are going to buy it for their primary residence. But it does get busy in that space when you're looking at duplexes. So
Yeah.
hopefully that answers that.
Yeah. I mean, there's a lot of inventory. If that were something you were interested in, I would recommend you talk to your agent about the details of it and how they approach it. Obviously, everyone has a different perspective on how they do it, but I would want to make sure that the HOA is sound financially before you would write an offer, because I would hate to have you buy a townhome or a condo and then find out that they're not spending your money wisely and get in that situation. So, good question. Let's talk about home searches. So there are a couple things. A lot of people are familiar with Zillow. I mentioned it earlier. It's a great site. It's a great site from a marketing perspective. But if you're on Zillow and you're looking at a home and you click the little contact agent button, that's going to go to somebody who's paying Zillow for your data, not the person who's representing that home, just for reference. Um, so they're not the same thing. MLS is the multiple listings service. I think that's right. MLS is it's what we use as realtors. So it's what I use daily. It's the front end of the data. The other solutions, Zillow and Realtor.coms and Homes.coms, they syndicate the data that's in the MLS. So they're sometimes a day, maybe two delayed. So if I'm putting a home in pending status because it just went under contract, it may not hit Zillow and some of the other solutions for a period of time. So, if you're actively looking, I recommend that you talk to your agent about getting a property alert set up that is data that comes from the MLS. So it's real time, it's more accurate. And we can do that fairly easily. Generally want to figure out the area of town you're looking at, the dollar amount you're looking at, the beds and baths, how many beds and baths, um, from that perspective. And so I'd recommend you have that conversation. Get set up on a property alert so you get an email with all the updates, either new listings or price changes in the market, and you can look at it from that perspective versus spending time on Zillow because it may not be accurate data, or some of the other sites because it may not be accurate data. So would recommend that perspective for sure. Um, Touring homes. When you get to that point, again, I recommend you go through the pre-approval first and then get to touring homes so that we're not touring homes and looking at homes that you can't afford. I don't want to get you in a situation where you fall in love and then realize you can't. So I would certainly, again, preface that. But touring homes, it's fantastic to have an idea of the area of town you're looking at, or maybe a top 3 or 5 list of homes. Um, it's best to book more than one a day, several a day, depending upon how much time you have available, how much time we can get together, and if we can line them up with the listing agents of those respective properties. But it says here, trust your gut in the first walkthrough. If you're walking through a home and you just have a feeling it's not the one, or you have a feeling that it is the one, trust your gut. And your agent will be along there with you for the ride and for the journey. And our job is we look at hundreds of homes. We look at a lot of homes, and so we'll guide you in from the sense of you may not notice, but there's an issue here, or you may not notice, but just the details of it all, and that's our job. Um, so, and again, also our expertise of being in a lot of homes, we know some of those red flags. Um, Foundation cracks aren't always a bad thing for reference. You may see some, and it may not be a bad crack, concrete cracks. But certainly, if it's shifting, or if you're seeing water stains, or the electrical line and breaker boxes looks really old, obviously those are things that we're trained and know to recognize, so we can help you when we're going through the process of searching homes. So again, less scrolling, more strategy will get you there more quickly, because there are so many homes in the market right now. What I say, 1,600 homes under 300,000. You could look online forever, and you could keep looking. And oftentimes, it's best to get into the homes versus just looking at them online. So it's a recommendation from that perspective. We get into the process of making an offer. It is to me, it's a fun time because it's where the rubber hits the road. It's where we start to get to work on the process, but it is, and I've been there myself. My wife and I have purchased 4 or 5 homes ourselves. So I understand the panic and the it's a big deal. So we want to make sure that we're prepared and ready for it. So just thinking ahead of time as to what actually goes into an offer. It's not always the purchase price. We mentioned previously, earnest money is a thing. Um, if we get into a situation where we're going to be writing an offer, the first thing I do is I either text or call, depending upon where our communication has been with the listing agent. I call the listing agent or I text them, and I want to get an understanding of what does your seller need to have as far as what are their needs? Do they want to be out by a certain period of time? So we're writing an offer on the 15th of the month. Do they want to be out by the end of the next month, or do they have to be out in 30 days? Or just understanding what those factors are. Um, and there are other things that they'll say are must-haves, but just knowing what those are so that we can put a competitive offer together and don't have to go back and forth on getting those things down the road. So I'm a uh, from a realtor perspective, I'm a more communication than others. I want to have a rapport with the listing agent. I want to know details about how many people have gone through the house. I want to know as much as I can so that I can put the best offer together uh, for your benefit as we get going. Um, so the contingencies are and closing timelines on there as well. Just understanding the entire picture so that we don't just write an offer thinking we know everything and then it falls flat and we lose the home and you guys have to walk away from the home of your dreams, which is not something we want to have happen. So just figuring all that out ahead of time and trying to put the best offer together. We talked about this already, and so we don't need to go about it again. I realize I should take this out. We do this again in the future, but it is hold in escrow. You will get it back if you walk away from the home for whatever reason, or it does go towards the down payment when things close, that earnest money. And then certainly competing without overpaying. Um, if you are pre-approved and you have the documentation ready, it puts you in a different light than others who aren't pre-approved. They can't move as quickly. Um, we're talking first-time home buyers, so it's not likely a thing. But if you're having to sell another home before you can complete this home, obviously it puts you in a different position. So just understanding the entire process to make sure that we're putting the best offer forward.
I think probably the main takeaway of the whole thing is that I think everybody assumes price is the
Yeah,
number one concern. And I think that just as a takeaway for it, I mean, I can list probably 100 different examples on people taking either a $5,000 less offer or $10,000 less offer because of a different hot button that was met that the other person wasn't. So there's some people that are selling this house and need to be into the other house at a certain time period, or um, you know flexibility with that, or whatever the case is. There's a countless number of things, but I think the key takeaway is that not money's not everything to everybody.
right.
Everybody wants to get the best price, but there could be other pertinent items. So just the main takeaway from that slide, I think.
Yeah, and also to that point, it's not on the slide, but we're talking about making an offer. A lot of times, and it's interesting. It comes from the Iowa nice of us all. We don't want to be rude, so we don't want to offend somebody. So we don't think we want to write an offer that's maybe lower than what they're asking for. Um, and I recommend, and I always would counsel, let's make an offer, even if it's lower than you think. It's say it's a $200,000 home. The unwritten rule of thumb is anything under 10% of that listing price is sort of a potentially an offer that could be offending to the seller. Um, but not all the times do you have the money to make an offer like that. In my opinion, it makes more sense to make an offer to start the conversation than to just walk away not knowing. So in that situation, it's up to me if in this situation, in this hypothetical, I'm the agent working with you on this. It's up to me to have that conversation with the listing agent and say, hey, listen, this is why we think this number makes the most sense. This is our background. This is our understanding of it all. And we're not here to offend you. Just make sure that it's presented in the best light so that it's not automatically rejected. And it is a starting point to a negotiation. It could be that, you guys meet in the middle. There's different ways to skin the cat on that perspective. But ultimately, at the end of the day, communication is the biggest thing from these offers and making sure that we're in the right position to get the house. So once an offer is accepted, usually there are extreme circumstances on either end, but usually once an offer is accepted, 30 to 45 days after that is when you close and take ownership of the house. Now, in that picture, usually 7 to 10 business days, and I say usually, sometimes that's one of the contingencies. We know they want to make decisions quickly, so we say we'll shorten our inspection period to 5 business days versus 10 to get it done and move quickly. And so understanding what all those different variables are is important. But usually 7 to 10 business days after the offer is accepted is the inspection period. So within that time, you need to get an inspector in there, have them review everything, figure out if we have to negotiate on any items, put together an addendum to send over to them of here's the things we want you to take care of, Mr. and Mrs. Seller, or pay us to take care of after the fact. So ultimately, within the first 7 to 10 days, that's the window there. And then also the appraisal period, Matt talked about this also before, is after that 7 to 10 day window, but before you get too close to closing, because you don't want to get too close and not have the appraisal done. So within that 30 to 45 day picture, that appraisal happens. Final walkthroughs are things we do either the day before or the morning of closing, depending upon what time of day closing is. If closing's 3 o'clock in the afternoon, we might do a final walkthrough at 9 o'clock in the morning. If closing is at 9 o'clock in the morning, we might do a final walkthrough the night before at 5 or 6. And that is your opportunity to make sure that you agreed upon washer, dryer, stove, microwave, all those things staying, they're still there. And also, when they moved out, they didn't damage the house and put holes in the wall or whatever it may be. So it's your last opportunity to walk through the home and make sure that the home is what you thought it would be and everything that you agreed upon is there. And because if it's not, then we have some time between when that walkthrough is and when closing is to address that with the other agent. I had a circumstance where the individual selling their home had a 1,100 pound safe in the basement. Movers did everything they could, but they damaged the stairs, moving that 1,100 pound safe up from the basement. Um, Obviously, the people buying the home didn't want to buy a home with damaged stairs, so we had to agree upon who had to do what and why and put that in writing within that time period. There are circumstances where you go in and, oh, that's not the refrigerator that we agreed upon, and it's detailed in the agreement. And so they took the one they wanted and swapped it out with a cheaper one. And so ultimately, just going through that process of making sure that it is everything you want it to be is that final walkthrough. And again, that usually happens as close to closing as possible, but still giving us some time to address things if they need to be addressed. And then closing day, a lot of times your lender will send you documents overnight electronically that you can do via DocuSign or an electronic perspective so you can get a jump start on closing. If that's not possible with your lender, you'll be doing a lot of signing at the closing day. Matt, you want to talk more into detail about that?
Yeah, I mean, with today's day and age, a lot of there's still some certain documents like the mortgage and the notes and a few other documents that need to be notarized. So usually it gets down to like 7 to 10 documents that actually need to be signed and notarized at closing. The rest of them can be just electronically done, and we can probably thank COVID for that, but it kind of thinned out some of the online stuff. So. Yeah, and usually closing takes it says an hour here, but usually we can be in and out within half an hour.
Yeah, it's a pretty smooth process. They've got it down to a science. Everything's printed off, ready to go. You come in, you sign, and you get your keys and you walk away. It's pretty painless process at that point. If you have a check that you're paying at closing, you of course need to have that ready ahead of time. There's some things there, but all of the details when you get to that point are given to you in an email form and a written form, so you can be prepared. And both your lender and your agent, if there's a closing, a transaction coordinator involved, um, they're all involved to make sure that it's the most smooth process it can be. No surprises, no chaos, clear path, so you can move in on accepting stay. So the full journey from renting to ready to keys, the timeline really looks for serious buyers, 1 to 3 months is realistic. Obviously, you could spend an entire month looking at homes and maybe not find the home of your dreams, so it could take longer. But with the amount of inventory on the market and the opportunity to do some analysis ahead of time on like a property alert email, like I mentioned previously, where you're looking at the market and you're looking through homes and saying, yeah, this maybe this area of town isn't what I'm looking for, or I actually don't like split levels. I would prefer ranch. Just sort of narrowing those things down ahead of time will make that process when you start looking, you'll be more aggressive and more intentional. So I think 1 to 3 months is certainly realistic. Um, you want to start, what would you do today if buying your home in 2026 is a thing, or what your plan is? Obviously, check your credit. There are free solutions you can do that won't pull your credit and have a negative effect towards your credit. You can see where you are today. And if you're not comfortable with where that number is, I would recommend contacting the lender and having a conversation, because then you can start doing the things that they recommend to get it better, and you have time to do that. Obviously, you want to start saving consistently, get pre-approved. The biggest thing is, well, there are a lot of big things in this, but one of the big things in this is don't quit your job. Don't go buy a car. Don't get more credit cards. Don't do the things that would affect your credit negatively, if you can during this process, especially if you're under contract and you're waiting for that closing day. You're in 30 to 45 days. If you go buy a car, that's going to negatively affect your credit. And then when they pull it come closing time, it could be different and it could hinder your ability to get the home. So be intentional with everything you're doing. Certainly save money, get pre-approved, talk to your agent, talk to your lender, get the ducks in a row, and then start your process. Most first-time home buyers certainly get stuck overthinking. There's no doubt it's a big decision and it's a big process, and so there's a lot that goes into it. We're hopeful that this presentation tonight helped to alleviate some of the initial concerns and can get you moving forward. But waiting for the perfect conditions is never going to be a thing. Matt, I've heard him say over and over again, people are waiting for the 2.5, 3% rates to come back. We're likely never going to see that in our lifetime. That was a a, a reaction to a weird society we were in 2020, with COVID and all the things going on. Um, so letting fear outweigh preparation is certainly not something that we should do, but it also a lot of times is where people get stuck. Um, so how to avoid getting stuck? Like we said, ask questions, build your team, take action with the things that you can control today, and start moving forward from that perspective. So your next step, we're not here to pressure. That's not our job. We're here just to give you options if you want them, if you have questions for us. My contact information's there. Most of you, I think, have it at some perspective. Matt's contact information's here. Um, he is readily available and willing to answer questions on a typical business day, sometimes outside of a business day, but he's very available and very willing. Um, and you can certainly visit us online with that perspective. So I do have a program. It's called Fast Track to Home Ownership. I'll be sending you guys who did attend tonight an email. I'm going to get you the checklist that I promised you, and also information on this Fast Track to Home Ownership program. There's also a QR code here in a little bit if you want to scan it to look at it. But it's a program where we work together up front to do your homework, to essentially we'll spend a half an hour initially or longer, depending upon how long it takes, developing your clear plan, making sure that we have the plan of action in place. We understand timelines. We understand the area of town that you're looking for, the type of home, all those things. We talk about credit and go through the entire process to make sure that when we start the process, you're prepared and ready to go and get started. And it's a program that has a guarantee, which we'll talk about here in a little bit. But it's a personalized roadmap, financial clarity. It helps you start the search, get you going. We talk about potentially offers and negotiations and what that looks like, as well as some partnerships, whether it be Matt as a lender or other lenders or inspectors or all the varying vendors that I work with that I have readily available. And we plan so much that there's no guessing when it comes down to it. It's for people who are renters planning to buy in 2026, first-time home buyers who want confidence before committing, and people who want clarity before touring homes. I have in this program, and you can scan that if you want to get more information on it now, a 90-day keys to close guarantee. So once you get credit approved, once you say, hey, Pete, let's go start looking at homes, I'm confident with the amount of inventory available and the process and having the preparation done ahead of time that I can get you in a home within 90 days. If that's what you want, as far as that timeline. If that's aggressive and too aggressive and you don't want to go down that quickly, you don't have to. But if we get going, you say, Pete, I want to get the guarantee. If I don't get you in a home in 90 days, I'll give you $500 back at closing whenever we get to that point. So it's a program where I'm intentional about being a resource for you and being helpful for you and getting going from that perspective. I think maybe there's a comment.
Yep. Just says
Or
thanks for your
question.
time and all the information. Very helpful.
Yeah, wonderful. Thank you. I will follow up with an email that will have a recording or a link to this recording, as well as that checklist and some other information on the fast track program. And I'm here. If there's ever a question that you need to have answered, I would love to answer it for you.
Thanks, everybody. Thanks for taking your Tuesday afternoon or evening to share it with us. But whatever we can do to help, we appreciate it.